You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the monthly update series for August 2013. And on today's show, our annuity update with special guest, nationally recognized annuity expert, Eric Palmer.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, Mr. Millennial Marketing, but more than that, annuity expert extraordinaire. And welcome to the show, Eric.
Glad to be here.
Eric, I got to say, I'm kind of excited now. I don't want to get too excited, but Treasury's going up, makes me happy.
Right.
And I've noticed that I thought that it would take a little longer for annuities companies to adjust to that, but it doesn't look like it. They're kind of moving on it. Am I just seeing things, or is that really happening?
Well, it's definitely happening. We're starting to notice a lot of cap changes. We're starting to notice insurance companies come out with stronger fixed guaranteed rates. We'll talk about some of that stuff in our annuity show this week, but or later on in the annuity show today. But it's interesting to see that it's moving up so quickly. Mm-hmm. You know, we were at 1.6 how long ago? Right. And now I believe it was as of this morning something like 1.5 or excuse me 2.59. Right. So we're at about 2.6, almost a whole point jump in the 10-year Treasury. And it definitely is affecting these insurance products. But I almost want to say, let's not get overly excited because, you know, if you look at in the last couple of weeks, there's been a couple of days where that Treasury's come back down and adjusted, whether it was, you know, 10 basis points, 15 basis points. So as it looks right now, it's starting to affect these products, but let's not get too comfortable, in a good way, but let's not get too comfortable and make sure that we don't grab onto it for too long.
Well, when I look at the Treasuries going up, and I've seen also a lot of other things, we'll be talking about this later in the week, I've even seen life and annuity company stock going up because of this, because they see this coming on, and I mean, we're all affected. I thought we'd never get out of this tranche we've been in. We've been at the bottom basement on interest rates. Tell me an example, though, in your idea. Give me a carrier that you said, man, these guys jumped on it, and this might be, I don't know if it's directly correlated to interest rates, but give me an idea. Do we have an example?
Well, absolutely. I mean, we've talked about the Genworth CapMax strategy. The Genworth index products is a 7-year and a 10-year. And this CapMax strategy is interesting because it has a pretty competitive cap, but it also gives you the capability of rolling that cap over for a 3-year period of time to get double-digit returns. But what was interesting in the month of June, and if you recall from our June annuity update show, we were really excited because they had just released an increase of their interest rates, and they went from, I believe it was 5.2 to 5.95%. And that was the second increase in interest rates in the month of June, and that was also the month that we really started seeing that Treasury start to come up. So I would say that that's definitely a correlation to that movement in interest rate. And you know, your comment earlier about some of the insurance companies, their stocks are trading higher as well. I think the reflection there would be, you know, the improvement in balance sheets. So we see a lot of insurance companies taking a lot of premium, and they aren't going so aggressive, I think, with the movement in the interest rates that they are reserving some additional margin for themselves. So AM Best came out and confirmed actually ratings for several different insurance companies, one of which was Athene Annuity. And Athene had an approval or a confirmation of their RBC was up, they had the confirmation of AM Best, and now we're starting to see that movement in their stock as well. So, you know, I think the correlation is both in product and in, like you said, the balance sheets of these insurance companies, therefore reflecting their stock prices.
Well, I can't wait to see this, if it's going to be sustainable. It has a lot to do with if the Fed is over. And I don't know if the Fed's over with their QE3. I don't know if they're going to keep funding. Really, fundamentally, unemployment is still pretty much the same.
Right.
So I heard it was kind of an aggressive posture by the Fed. Now it seems like they're kind of cooling their jets on this issue because they're concerned that maybe it's not quite over. So we'll see what happens. And I noticed, by the way, a little side note, I noticed that the Fed now just declared that their bailout to GM, just as a little side note, is going to be a little bit short. So we're not going to get the kind of shareholder value as a taxpayer that we thought we were going to get. So that might give them pressure to keep rates kind of capped for a little bit. So I like whatever movement we're seeing right now, I like it.
Well, and I would definitely say take advantage of it, because we have to remember at the end of the day, you know, how many times have we heard the Fed change their mind in the last couple of months? You know, Ben Bernanke comes out and he says, you know, we're going to pull back on quantitative easing. We're not going to buy $85 billion a month in these bonds anymore. And then there was a lot of movement in the stock market. Okay, and so then what happens when the stock market starts moving in the wrong direction? The Fed suddenly comes out and says, well, you know, maybe we'll just keep this going until 2015. So there's all this back and forth. It's like a tug of war. So I would say, for taking that kind of knowledge and applying it to the field, when you're sitting down with your clients and you're talking about high caps and high opportunities, put the pressure on and say, look, we don't know what the Fed's going to do. It seems that they change their mind all the time, and they could go in any direction.
True.
So while these rates are strong, let's lock them in. Let's get you the top caps or the top fixed rates right now in the marketplace while they're there.
What is the top fixed rate right out there right now? What would you say?
Actually, that's a great transition into a product that was just launched by Forethought Annuity. Forethought came out with a product series that has several different options. They realize that there's a big drive towards accumulation right now in the annuity marketplace. It's not just the guarantees on the lifetime income riders and the death benefit riders, but there's also a shift to wanting accumulation now that these rates are up. One of the top rates that we're seeing on the fixed side right now is in a product that actually Forethought offers. It's at 3%. Genworth also has a product at 2.45%, but I think a 3% fixed rate right now.
What's the period?
It's a 10-year annuity. But coming out of the interest rate period that we've been in, 3% fixed as an option on an index annuity is pretty powerful.
So can you pivot during this time period? 10 years, I'm fairly pretty positive about the S&P 500 or whatever index you're using. I'm going to go over there and stay out of the 3%. Can I do that?
Absolutely. And an annual reset, you have the opportunity to reallocate. So one of the things that we're looking at as a strategy with a product that has a really strong fixed interest rate, but also a really strong growth cap, is compare that to a bank CD. And Genworth actually has a great model that if you call up to the biz, email Steve, you can actually get a copy of this worksheet we've put together. But it's the ability to use that fixed rate to hedge the guarantee that you have in your CD right now, and then take the difference and let it be a part of the index growth. You can knock out a CD all day long.
You could hold at 3% until you saw the regular interest rates going up at a CD and then punt and go over to the index. Is that what I'm hearing?
Or split them, put a little bit in the fixed that marks your CD, and then go rest in the index.
Well, we're going to come back and keep talking about our August 2013 annuity update with Eric Palmer. And don't forget, you can enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can go to today's materials at thebiz.tv. And while you're out there, click on the Biz blog for the Backroom Technician 30-day free trial offer to access the best needs analysis and client education material that almost address almost every financial planning scenario. And just a heads up before moving forward with anything that you hear on our show, always consult your tax advisor and your legal counsel as well as your broker-dealer compliance officer if you are so FINRA licensed. We're in the middle of our monthly update with Eric Palmer for 2013 on annuities, and we just talked about kind of within this product now, I can protect it against a CD rate and participate in indexing. Talk about how you split this, because I think this is unique. We usually talk about combining two different products. Now we're kind of doing it within one product.
Well, yeah, we'll always remember that with these index annuities, we have the capability of splitting our allocation. It doesn't have to be all eggs in one basket, right? So we can put a little bit of money in the fixed rate, a little bit of money in the index. Well, what's interesting is if you look at a model where you have $100,000 of premium sitting in a 5-year CD, and if you go to bankrate.com, you'll see that the average CD rate in the country right now is 0.8%. Okay?
That's horrible.
It's horrible. But if you have 80 basis points working on $100,000, you're looking at $800 of interest. Well, when you look at a 5-year index annuity with Genworth, for example, they have a fixed rate of 1.7%. So it's only going to take $34,000 at 1.7% to create that same $800 in interest. So what we can show our clients is that for $34,000, we can get you the same interest results that a 5-year CD at $100,000 can get. So what that does is that leaves us the $56,000 left over that we can allocate into that capped strategy on an index. So that at that point, we have $56,000 out earning what that $100,000 CD would do. When your client looks at that model, they're going to see that that's a better use of their money, and that even though they've got this $34,000 locked up to get them the $800, they could be out earning that CD by 2 or 3 times.
I love the idea because how many contracts will allow us to match up to CDs and then take the difference, as you're suggesting, and put that over on the index side of the equation?
Just about all of them, and just about every index annuity that's out there today will allow you to do that combination. But what's interesting is, you know, the client's perspective is going to be based on that surrender charge period, because why do we buy 5-year CDs? We want access to our money, we want some liquidity, we want short term so we can see what happens 5 years from now. So there's not a lot of companies out there that have 5 or 7-year index annuities. Genworth happens to be one of them right now, and on their 5-year it's got very strong rates. Their 7-year is off the charts. If you can get your client to go with the 7-year, we're talking about a 2.45% fixed rate. That means more money allocated to the index strategy and more opportunity for additional interest. So I hone in on Genworth a little bit because they just have those shorter terms. And remember, that 5-year CD is taxed. That 5-year index annuity is tax deferred. So that's also going to give you more power on the compounding of that interest rate.
Well, when I look at the difference, though, I'm trying to think of a client who is locking down on a CD. If he left early because of liquidity issues, he's going to be penalized by the bank.
Right.
Okay, so are the surrender charges on some of these equal to, are they same? Because, you know, you have to look at the net result.
Sure.
But there's still illiquidity with CDs, and I think people forget that.
Well, absolutely. You know, I would say that in most cases you're going to see that the surrender charge is going to be a bit higher than that penalty with the CD. But if you take into consideration the penalty plus the taxes, we're very similar. We're coming very close. And remember, at the end of the day, your client wants to know there's some liquidity, but they don't necessarily need it. And so the annuity at least gives them the advantage to, at the end of that 5 years, if they don't need the liquidity, they can continue to move that into an additional annuity product.
There's some withdrawal benefits.
There are some withdrawal, and they have the 10% free withdrawal. So, but that also gives them the opportunity to continue tax deferral if they don't end up actually using the capital. And I think that's just a better use of your money, and especially in a low interest rate and a potentially rising interest rate environment.
For our purists that are out there right now, and especially because we have a good consumer audience, Eric, what if I just said, you know, it's too complicated, I can't understand the split issues, the index issues. What's my 5, 7, 10-year fixed rate? I want to match it up to my bank rate. What is that?
It's actually very, very simple. If you want to go and look at an actual model, I would say, you know, contact us here at the Biz, and we'll actually show you. We have a 1-page sheet, and we're actually put together a little video where I draw this out in numbers and show you what a 5-year is and a 7-year is. And right now we are using Genworth because they have a 1.7 fixed rate on the 5-year, and they have a 2.45% fixed rate on a high band right now with their 7-year. So we're sticking in that zone because I think that model works really well when you're comparing against the CD. And if you're interested in seeing some of that material so you can visualize it, because I'm a visual person as well. It sounds great when we say it, but it's nice to see it. Give us a call here or send an email off to Steve, and we can get you that material.
Have we seen any really fixed rate annuities with the treasuries? Have they moved up a little?
The multi-year guarantees, absolutely. You know, and if you're looking for just that pure guaranteed rate across the board, we have seen an uptick. Sentinel's back, moving their rates upward. You know, we're getting into the 3s again on the 5-year multi-year guarantee.
Wait, whoa, hold on, just I want to make sure. So we have carriers right now. Is one of them Sentinel, you were saying?
Sentinel's close to 3. They're getting there.
They're close to. So we're getting right up around 3, because I remember, I just want to say a month ago they were like at 275 for 5.
Right.
So now we're almost at 3.
We're almost at 3. And remember, again, that Treasury moved almost 100 basis points. So, you know, to see a quarter-point tick in a multi-year guarantee annuity is not a bad deal.
No, I mean, we're going to have purists out there that say, listen, I just want to compare apples to apples. The only difference is, and remember, and I don't want to short this because Eric and I live in this zone, but I want to just reiterate the power of tax deferral. When I'm holding it, there are some equations that show that if I hold it long enough, not only am I going to overcome a lot of issues with CDs just on the rate to rate issue, but I'm also going to be able to look at, wow, the longer I hold this, could that be competitive against capital gains?
Well, that's absolutely right. You have to analyze the long-term tax effects, and even if I take distribution eventually out of these annuities and I will pay some taxes, was the compounding interest difference, the taxes I would have paid on the fixed asset
That's
through
right.
like a CD.
That's right. And that's why you're always looking at the power of deferral on a timeline. Well, that's what we're talking about today. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.